Assalamu alaikum. Welcome to lecture 24 of ATX. This is the continuation of VAT that I have introduced you in lecture 23. Now we are going to finish off VAT. This is the last lecture under VAT. So we are going to continue with the administration process of VAT and overseas aspect. This is a small lecture. A lot of the technical areas on VAT was covered in the previous lecture. So please go back to my lecture 23. You can access the previous lecture under ATX playlist. Now, here we are going to focus on electronic filing of VAT returns, penalties for late filing and late payment, errors on a VAT return, late payment interest, overseas aspect and summary. So penalties, overseas issues. Now, electronic filing. All business must file the VAT return online and pay VAT electronically within 1 month 7 days. For VAT, this 1 month 7 days is very important. You have to remember this date. Okay, within 1 month and 7 days of the end of the return period, you have to file your VAT return. Next, following the introduction of making tax digital, businesses submit their VAT return to HMRC via a specialized software. Details of making tax digital will not be asked. Now, substantial traders. Substantial traders are those whose VAT liability exceed 2.3 million per year. Okay, so monthly payments on account are required for them. Payments at the end of month 2 and 3 in every quarter are 1/24 of the annual liability for the previous year. Any additional amounts are paid with the normal VAT return. Other methods can be agreed with HMRC for calculating payment on account. A trader can leave the scheme if its latest annual VAT liability is less than 1.8 million. Now, penalties for late filing and late payment. There is a new system that is introduced in 2023 to replace the previous default search rules. Now there are separate penalties for late filing of VAT returns and late payment of VAT. Two things are there. One, late filing of VAT returns. One, late payment of VAT. There are two separate things and there are two separate penalties for them. Now, for filing late the VAT returns, this is a point-based system. Okay. Each time a quarterly VAT return is submitted late each quarter, a taxpayer receives 1 penalty point. Once the taxpayer reaches the threshold of 4 penalty points, a 200 penalty is charged. Every subsequent late VAT return will also incur a £200 penalty, but the points total will not increase further. It will increase up to 4. Your penalty will keep increasing by 200. While the taxpayer is below the penalty point threshold, that is 0.4, each penalty point expires after 2 years. Now, this is, however, once the threshold has been reached, penalty points do not expire. Once you have reached 4, it will not expire. So instead, the taxpayer must submit all VAT returns on time for a 12-month period. 4 quarterly returns to reset the points to 0. If you want to reset the point to 0, you have to submit all your VAT returns for a 12-month period. That means 4 quarterly returns will be there to reset the point back to 0. There are different point thresholds for annual and monthly returns, but this will not be asked, only quarterly. Now, so that is for late filing. Now, late payment of VAT. If VAT is paid late, HMRC will impose a penalty for it. This is how penalties are calculated. This is easier. Up to 15 days, none of the penalty. 16 to 30 days late, 2% on the VAT due, and more than 30 days, 4% plus 4% daily penalty. Okay, percentage of VAT due. The penalties for late submission and late payment may be cancelled if the taxpayer has reasonable excuse. You can cancel these penalties if you have reasonable excuse. Now let us do a question. Illustration 1. Okay. So now you have to explain the late filing and late payment penalties incurred by Mark. So Mark's return for the quarter ended 30th June was submitted late. VAT due of 14,500 was not paid until 16 August. Now, his return for the following quarter to 30th September was also submitted late, and VAT due of 16,200 was not paid until 28th November. Mark had previously received 2 penalty points for the late submission of VAT returns in the past year. So now, there will be 2 times they are late. One for 30th June, one is for 30th September. So let us see for 30th June what is the penalty. Okay. Remember, when you have incurred quarterly return late, okay, 1 penalty point. So 1 penalty point incurred for late submission, making 3 cumulatively. 2 in the past and 1 now, because for 1 quarter you have paid late. So 1 penalty. Now, if you see the payment was due on which date? One month, 7th day. 1 month, 7 day from 30th June will be 7th August. You are supposed to pay by 7th August, but you are not paying until 16th August. So 7 to 16 is less than 15 days. So no penalty. Because it's less than 15 days, there is no late penalty. This is why you need the table to decide. Next, when you are paying for September, you get another penalty point. So 1 penalty point is incurred for last submission. Now you are having total 4. Now if you are having 4 penalty, there will be a late penalty of 200 that will be charged as well. Okay. So now we'll see. For 30th September, it will be 7th November. 1 month, 7 days. Okay. It will be 7th November. So payment was due on 7th November. One month, 7 days. Whole month of October and 7th of November. But you have paid on 28th. So if you see from 7 to 28, you are 21 days late. Isn't it? 21 means it is between 60 to 30. So 16 to 30, penalty is 2%. So on the 16,200 you have to pay 2% penalty. So your penalty is 324. Next, when you are making an errors on a VAT return, one is late filing, late payment of VAT, the other one is error. So when you're making an error, remember VAT is a self-assessed tax. So traders calculate their own liabilities or repayments. Therefore, it's very possible you can make a mistake. So what do HMRC do? HMRC, they often make occasional visits to check whether returns are correct or not. HMRC has the power to enter the business premises, to inspect the document. They can check your statement of profit and loss, statement of financial position. They can take samples. They can inspect computer records. Now, errors on earlier VAT returns. So if a trader realizes that there has been an error which can lead to standard penalty, okay, what should they do? So now error. Error is found by the trader and they are disclosing it voluntarily, or it's found by HMRC. Impact is different. If it's found by you and you're disclosing it voluntarily, there's a de minimis limit of error. You have to check the limit of error. De minimis limit of error. You have to see the de minimis limit of error is greater of these two things. Greater of 10,000 and 1% of turnover subject to an upper limit of 50,000. Whichever is the greater is the limit of your error. Next, if your net error is less than the de minimis limit, you have to include it on your next VAT return. If your net error is greater than the de minimis limit, there's a separate notification. That means error is more than the limit. Now, if it's found by HMRC, they issue an assessment within 4 years of a relevant VAT period. This can increase to 20 years also if deliberate error. Deliberately you have done the error. Now, whether it's found by HMRC or found by trader. There is a standard penalty for submission of an incorrect VAT return. Next, if it's found by HMRC, they have an option. The taxpayer has an option to request review of decision by HMRC review officer, and then they can appeal to tribunal within 30 days. This is the procedure. Next, late payment interest. As for other taxes, interest will be charged if VAT is paid late. Same. Interest is charged on a daily basis from the due date till the date of the payment at 6.5%. In your exam, calculation should be performed to the nearest month and nearest pound unless question says otherwise. So this is the late payment interest summary, penalties and interest. Remember, penalties is a separate, interest is separate, okay? Sometimes you will be incurring both. So late filing penalty. Each late return, this each means for each quarter, not monthly or annual. They will always give you quarter, don't worry, 1 point. If it adds up to 4 points, you will get £200 penalty also. Late payment penalty. You have to check whether you are paying the VAT late up to 15 days. If up to 15 days you are late, none. More than 15, that means 16 to 30 days late, 2% of VAT due. More than 30 days, 4% of the VAT plus 4% daily penalty. It's plus two things. Next, late payment interest applies to all VAT paid late, runs from due date to the date of payment. Then errors. If your net error is less than or equal to the greater of 10,000 and 1% of turnover, remember this is subject to an upper limit of 50,000, okay? That means more than 50,000 they will not accept. Include in your next VAT return. If your net error is more than or greater of 10,000 and 1% of turnover, advise the VAT office. This can lead to a penalty for submission of incorrect VAT return. There's a standard penalty. Penalty subject to the behavior of the taxpayer and is a percentage of the revenue lost. Behavior means, are you deliberately doing the error or carelessly doing the error? Now let us do a question. Illustration 2. So here, state whether a penalty for submission of an incorrect return will levied. If so, discuss the maximum penalty and state the position with respect to interest. So here, they forgot to include output VAT of 500 of taxable supply. They have given you the output and input and due to HMRC. They have underpaid VAT on 6th June 2024. This is for quarter return 31st March 2024. Okay, this has been discovered on its previous VAT return for the quarter to 31st March 2024. So now we'll find the VAT. Okay, so 500,000 is VAT exclusive. 20% of 500 is 100. Okay, so this error is to under declare output of VAT. The error has made is to under declare. Because of this error, you have under declared the output VAT. You're supposed to show more output VAT, now you're showing less output VAT because of this error. So now there is an understatement of VAT liability. Now you have to correct it. Okay, so the standard penalty will arise. See, you have to state. They didn't tell you to calculate or anything. They told state whether the penalty will arise or not. That's why we are giving reasons. So the standard penalty therefore arise according to the amount of tax understated, reason for the understatement, the extent of the disclosure by the taxpayer. Depends on three things. Okay, and the level of the penalty. See, this table was given before as well when we were doing income tax based on the taxpayer's behavior. Same table we are using here. Okay, so the level of the penalty is based on the behavior of the taxpayer. Are they deliberately concealing? Deliberate, but they have not concealed and they are careless. Okay, so you can see maximum penalty. This is minimum penalty, unprompt disclosure and prompt disclosure. Okay, now The above table will be given to you in your exam. This table is given. You don't have to worry about this table. It will be provided to you in your exam. So based on that, you have to see. Okay. So here, it depends on the behavior. If they are making careless, they're deliberately showing. Okay. See, if they're deliberately concealing, deliberate and they have concealed, maximum penalty is 100%. But if they are making the disclosure, whether it is unprompt or prompt, depends on that. You see, if they are making unprompt disclosure, it is the lowest rate. So this depends again on the behavior. They have not, the case study did not give you the behavior. Okay, so it depends on the behavior. And if you are making a genuine mistake, no penalty. But here if you see, hopeless, did they voluntarily disclose? No, they have not voluntarily disclosed the error. Otherwise the question would have told you. This was instead discovered by HMRC. So no reduction is likely to be made for unprompt disclosure. There is no reduction for it. So while now interest also will be charged from the due date of the payment of the VAT till the date. If you check, it is March. Since June. See, they have discovered on his previous VAT return for the quarter. This time it will be 30th June. So from 31st March you have made the mistake. So from 31st March 1 month 7 day is 7th May. 7th May is your due date, but you have underpaid on 6th June. So from 7th May to 6th June you have to calculate how many days. If you see, it is 7th May until the date of payment 6th June. You have to calculate that to the nearest month. So it's just 1 month, May and June. That's why 1 month, what is the percentage? 6.5, and on what? On the VAT, 600,000, not on 500, on VAT. So this will be your interest charge, 542. The last part of this lecture is the overseas aspect. So when you are importing goods, see, goods and services are dealt separately. Import, export of goods, import, export of services. These four things are dealt separately. When you are importing goods, okay, a postponed VAT accounting system generally applies where a VAT registered business accounts for the VAT on goods purchased from any overseas country on its VAT return. So the purchaser accounts for the output VAT at the relevant rate known as input VAT, and they can reclaim this input VAT subject to the normal rules. If all of the input VAT is recoverable, the effect will be tax neutral because output VAT and input VAT will cancel each other out on the return. The input VAT is accounted for on the VAT return which covers the date the goods were imported. Very important. Now, traders who are not VAT registered, who are exempt traders, they still have to pay this input VAT, but they will not be able to reclaim it. Now, postponed accounting. See, this postponed accounting is optional. There are some situations you cannot use it. For the purpose of your exam, it is assumed postponed accounting applies to all imports. Now, export of goods. When you are exporting goods outside the UK, it is always zero rated supply. So thank God it's easy now. Zero rating is a favorable treatment for the exporter as it allows them to recover import tax. If it's a zero rating, see, if you are not exempt, it's zero rating, still you can reclaim your import tax. It also means the customer is not charged VAT in the overseas. Now let us do question. Test your understanding 1. Outline the VAT treatment in each case for foreign. So foreign is a UK resident company registered for VAT has following international transactions. He has a sale of children's toy to a customer in Germany who is VAT registered. Purchase of silk fabric from Hong Kong. One is export. First one is they are exporting to Germany. Next they are importing from Hong Kong. So exporting to Germany, it will be 0 rated. This is 0 rated because it's export. They are exporting outside UK. Next one, it's an import. So they will account for output VAT. Foreign Limited will account for output VAT on its VAT return. And then they will recover this as an input VAT on the same return. This happens when you are importing goods. What do? When you are importing goods, you account it for output VAT, and on that same you recover input VAT. This happens in overseas. You can't do this in domestic. Okay. Now, supplying of services. This is what is my most favorite area. It's a tricky area. This area could be tested by your ATX. More than imports, services is a complicated area when it comes to overseas. So here it's complex. So this notes just cover the basic principles that are needed for your ATX. Actually, in real world, this is very difficult calculating VAT on supply of services. But for your ATX exam, only basic things will be covered. So for services, VAT is generally charged at the place of supply. Okay, the place of supply depend on whether the customer is a business or a non-business customer. If it's a business customer, place of supply will be where the customer is established. If it's a non-business customer, place of the supply will be where the supplier is established. This you have to remember. Okay. So you are supplying the service to business customer. Place of supply will be where the customer is. If you are supplying to non-business customer, B2C, place of supply will be where the supplier is established. Now, so this table is very helpful when you are supplying the services to overseas business customer. It's a business customer. Place of supply is overseas. Okay. Place of supply is overseas. This is outside the scope of UK VAT because supply is overseas. So thank God. Next, overseas, you are supplying services to overseas non-business customer. Now the place of supply is in UK where the supplier is. So this is in the UK VAT. So what do? You charge output VAT. You are supplying services. Output VAT is charged at the standard UK rate. Till here it's easy. When you are receiving services, earlier you were selling services. Okay, you are supplying the service. Now you are receiving the service. Same from overseas business. Place of supply is UK because you are receiving it in UK. Reverse charge procedure. This reverse charge procedure is the area I'm talking about. This could be asked in ATX. Be prepared for this. This is a tricky area, but it's easy once you get it. It's a reverse charge. What happens is, see, you are receiving service. It's like import, right? But what do UK do? UK business accounts for output VAT as standard UK rate on VAT return, and then they reclaim this input VAT. They reclaim this VAT, then they reclaim as input VAT. If you remember this much, this is known as reverse charge. That's it. You will not receive, if you are receiving service from overseas non-business customer, place of supply is overseas, so it's outside the UK VAT. Only this three you have to remember, especially the reverse charge procedure. Next, time of supply. For cross-border supplies of services, time of supply matters. So the rules are governed by when a service is performed, and a distinction is made between single and continuous supplies. For single supply, tax point occurs on the earlier of, when service is completed or when it is paid for. It's easy. For continuous supply, tax point will be the end of each billing or payment period. So now, before we summarize, let us do one final question. Test your understanding too. Outline the VAT treatment in each case for ginger. Okay, so Ginger is a UK resident trading company registered for VAT. So A, B and C. A, Provision of consulting services to Greta, who is resident in Germany. First we'll do the first one and then we'll go to the next two. They are giving services to whom? Greta. So they are giving it to Greta. They are giving it to non-business. They are giving it to business to consumer. It is not business to business. So the supply will be the supplier's place. It is the Ginger Limited. That means place of supply will be the supplier because it's business to non-business customer. Okay. So the supply is deemed to take place where the supplier Ginger belongs. Ginger, its UK will charge an output VAT on the provision of services because they are giving services. So A is normal. B, provision of consulting services to a company resided in US. Now they are giving business to business. So this is outside the scope of US. This is outside the scope of UK VAT because this is business to business. So the supply belongs to where blonde belongs. That is the supply. Place of supply is US, outside the scope of UK VAT. Third, Ginger purchased accounting services from Urban, an accountancy firm registered in France. Here, please again, this is where a reverse charge will apply. RCP, reverse charge procedure, will apply. Why? They have purchased the services from another business. This is business to business. So the supply is where Ginger is, where the customer is. So this is taking place in UK. What do? Ginger record output VAT at the standard rate and on that same they reclaim it as input VAT. This is known as reverse charge procedure. So now let us summarize VAT. We started with error, penalties, late filing and late payment. The 4-point system, 4 is maximum, you can reset to 0 if for 12 months, for each 4 quarter you are paying on time. Okay, for each quarter payment you are paying, adding 1 point. When it reaches 4.200 penalty is charged. Next, standard penalty. Then we have interest, runs from the due date of the VAT till the date of the payment, and it follows if you are less than 15 days, 16 to 30 days and more than 30 days. Interest will vary. Now, overseas issues. Cross-border services. Place of supply matters. If it's business to business, where customer is based. Okay. Customer applies reverse charge procedure. Okay. Next, if business to non-business, where supplier is based, it is mostly outside the scope of UK VAT. Time of supply. Single supply, earlier of date of completion, date of payment. Continuous supply, end of each billing or payment period. Next, trading outside UK. Imports. You record output VAT at relevant rate, then reclaim input VAT on the same VAT return. Export, 0 rated. Export outside the UK is 0 rated. So that's it. With this, we have completed VAT, and with this, I've completed the portion of ATX. One more lecture is remaining. That is the last lecture coming up. Lecture 25, that is on ethics. So see you in the next final lecture, and make sure that you watch my previous lectures. I've completed income tax, capital gain tax, inheritance tax, corporation tax and VAT. Now only one more lecture, ethics, is left to finish off ATX. I've finished my job. Now it's your task to pick up the revision kit, pick up the past paper on your CV platform and do as many questions as possible. As you know, the exams are near. Thank you for watching, and do not forget to subscribe if you haven't subscribed to my channel.